A lot of folks are interested in websites such as Fundrise, Patch of Land, and so on and so forth. So, in today's conversation, what I want to do is help you invest in, actually teach you how to invest in crowdfunded real estate online like a pro. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you're all doing fantastic. I'm doing marvelous. If you were to ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today's conversation is very simple. We are going to talk about how to invest in crowdfunded real estate online like a pro. So, how to actually master the whole process on websites such as Fundrise, Patch of Land, CrowdStreet, and so on and so forth. But before I get into the actual step by step, I'm going to lay out the foundation, the analytical journey that we are going to follow today. First of all, what is real estate crowdfunding? Crowdfunding is actually a way to fund a project or venture by actually pulling small investments from a large group of investors. So the idea here is that when enough people make small investments, it is possible to raise substantial amounts of money quickly, right? And so, what are the pros and cons of a real estate crowdfunding? For the pros, you have real estate exposure without having to own, finance, or manage properties. So, this is pretty cool if you have a 9 to 5 and you have no time or no interest or no capability in running and managing your own property, right? Low minimum investment, so you can actually access assets that will be unaffordable otherwise. You have high profit potential through distribution and a lump sum return at the end of the investment. So we're looking at double digit ROI here, right? You have automatic investing on most platforms. Investors get access to the real estate market with small amounts of money, and you can choose in which real estate project you want to invest your money. And the cool thing here also is that you have access to a large constellation of projects. So choice really at the end of the day is not a problem. And you have lower investment sizes in any single project. You can invest as low as $500 or $1,000 in small increments on a single project. What about the cons here? So real estate investing in general, and particularly real estate crowdfunding, can be illiquid. In other words, your money may be tied up for at least 3 to 5 years, in some cases 10 years. You have a higher risk than other types of equity investments. You have high fees depending on the platform and investment you choose. And what we've seen in our research is that some opportunities are only for accredited investors. I'll explain what accredited investors means later on. And you must be a U.S. accredited investor, to sort of take advantage of those opportunities. And the risk of investment default from real estate developers is higher for crowdfunding compared to peer-to-peer and direct real estate investment funding. And the investment risks are the same as for any real estate investor. So if the market happens to go south, guess what? You will likely lose your money. So let me just continue laying out the foundation here. How does real estate crowdfunding really work? So real estate investment platforms such as Fundrise, Patch of Land, CrowdStreet, they actually connect investment opportunities with funding. In other words, they just identify the opportunities and they look for investors who are willing to bet on those opportunities. So most real estate crowdfunding deals will have a sponsor, right? So I want you to picture the whole process here. So you have a sponsor, you have a crowdfunding platform, and you have investors. So the sponsor is the individual or company responsible for the project. So the sponsor in this case will acquire, they will manage, and they will sell the investments. So that's one part. And then you have the crowdfunding platform. So this website will actually connect the sponsor to interested investors. So it explains deals to potential investors, handles regulatory issues, and collects money from the investors on behalf of the sponsor. And then the third the third element in this trifecta is the investor. So you, me, or anybody else there. So the investor contributes to the project's funding in exchange for a share of the profits. And the share of the profits can come two ways. So you have an appreciation of the underlying assets, so the property, and also the quarterly or biannual dividends. And you can actually start in real estate crowdfunding very simply just by signing up with one of the at least one of the many platforms we have reviewed on this show, and you can actually you can make money from it. We've seen ROIs in double digits. We've seen ROIs in the teens, all the way to 20% to 25%. One thing I should just say here is that the higher the risk, the higher the ROI. That just makes sense. This is just the basic tenets of investment in general, right? So, and the more money you have, the more opportunities you have. In other words, if you are an accredited investor, meaning you have at least you make at least $200,000 a year, you are able to access a larger array, a larger constellation of real estate deals. And please understand that real estate crowdfunding investments are different from REITs. So REITs, real estate investment trust, they're companies that own real estate like hotels, malls, shopping centers, or rental properties. Publicly traded REITs can be purchased through a brokerage, just like individual stocks or mutual funds. Okay, real estate crowdfunding platforms such as Fundrise, on the other hand, they pull funds together to let average investors participate in the real estate market through private REITs, which are not available through traditional brokerages, as well as private market real estate investments like individual properties. So this could potentially provide higher returns than the REITs available through traditional brokerages, but they also may carry higher risks. Okay, something you need to be aware of. Okay, so now that I have actually laid out the analytical foundation of today's conversation, let's get into the actual step-by-step. How to invest in crowdfunded real estate online. Step number one, I want you to assess your investment risk. Very important. You need to evaluate where you are in terms of investment risk. And there are several ways to do this. First, you want to understand your current net worth. Your net worth is your total assets minus your total liabilities, whatever you own versus minus whatever you owe. You also have to have an understanding of your risk profile. So when I speak about risk profile, I'm talking about where do you find yourself on the risk spectrum. Are you neutral? Are you risk averse? Are you a risk taker? And this is the kind of conversation that you have to have with yourself, depending upon your financial sophistication, your level of financial education. If you have a financial advisor, that person can help you. But it also depends on your financial situation, your age, because the older you are, the older you get, the less risk taker you are. In other words, you become risk averse. And the younger you are, the more risk taker you are. So those are conversations that you're going to have with yourself, with your spouse, with your financial advisors. You also need to think about your savings ability, your savings availability, not ability, availability. In other words, do you have, at the moment, do you have an emergency fund? Do you have a rainy day fund? Do you have a regular savings account? Those are things you need to take care of before you even think about investing in crowdfunding real estate online. You have to think about your level of investment education. Are you sophisticated in terms of investments, or are you newbie? If you are, can you get the education? Can you level up? Can you actually can you increase your skills? Those are things you need to think about. Should you hire a financial advisor to help you on your crowdfunding real estate investments journey? So this is very important. You also want to understand the types of deals you would see in real estate crowdfunding. So you would see debt deals and equity deals. So with debt deals, you act as the bank, you along with all the other investors, okay? So you agree to lend the borrower, often a fix and flipper, money at a set rate of interest. So you'll be paid back at a predetermined rate, usually on a monthly basis, and paid interest owed. And at the end of the term, you are paid back the principal, which is the original amount of money you invested. And for equity deals, you have different deals. You have a single syndication, you have funds, you have rates, and I want you to pay attention to the fees also. It's very important. Here are some examples of platforms and different types of deals. So we have alpha investing. Here you have single deals, debt funds. They also have their own fund. CrowdStreet, you have real estate funds. They have their own fund also. You have EquityMultiple, single syndication deals. For Realty Mogul, you have syndications and rates. And Fundrise, you have rates and E-rates. So you have to decide whether you want to invest in equity or debt and what kind of returns you're looking for. It's very important. So you need to learn the difference between debt and equity deals, learning the numbers behind deals and what kind of tax implications each of them has. Step number 2, folks. So after evaluating your investment risk, I want you now to think about your current portfolio's beta. You need to know your current portfolio's beta. What is beta? Because this is something that you really need to understand. The value of any stock index, such as the S&P 500 index, moves up and down constantly, right? I'm just trying to paint a picture for you here. So if you look at the S&P index, at the end of the day, at the end of the trading day, we conclude, for instance, that the markets were up and down, right? An investor considering a particular stock may want to know whether that stock moves up or down just as sharply as stocks in general. So the investor may be inclined to hold the value of a stock on a bad day or get stuck in a rut when most stocks are rising. So the beta is actually the number that tells the investor how that stock acts compared to all other stocks, or at least in comparison to the stocks that comprise a relevant index. Let me bring that metaphor now into the crowdfunded real estate space. So you want to know the beta of your current portfolios, but you also want to know basically all the assets that you are interested in buying, all the properties you're interested in investing in. You want to know the beta of those properties, and you have to do the analysis at 2 levels. You have to know the beta of the individual property and the beta of the cumulative portfolio of properties. So you need to have a single beta and you need to have an aggregate beta. All right. Now, one thing I want to say here is that, and I don't want this conversation about beta to be too technical or too sophisticated. This is not a course this is not a PhD, a PhD finance course. So I'm going to be very, very, very clear here. Beta is important because it allows you to know whether or not you are in sync with the market, whether or not you are actually taking too much risk compared to your risk profile. It allows you to know whether or not you're leaving too much money on the table, whether you should get rid of some assets or buy more of them. So let's say if you are investing in real estate crowdfunding and you realize that investments in a certain part of the country, for instance, in California, are doing way better than the investments that you have, let's say in New Jersey, for example, then you might want to actually rebalance your portfolio to make sure that the portfolio's beta reflects your risk profile. And where do you find the beta number? There are a lot of ways to calculate it. Most brokerage firms calculate the beta of securities they trade and then publish their calculations in a beta book. And these books offer estimates of the beta for almost any publicly traded company. So you can actually ask your crowdfunded real estate platform for the beta. You can use free investment software. You can use free investment ROI calculator. For example, we have Calculator Edge. We also have calculator.net. Another way to find the beta number is to use free Excel templates, or you can do it yourself. So we're showing you right now, there are 2 great articles about beta calculation. The first one is on Investopedia, and the second one is on Benzinga. So those are great platforms here. So one thing I want to say before closing here is that based on your portfolio and the portfolio's beta, you need to find the right type of crowdfunding real estate investment, because at the end of the day, the goal is to maintain your current beta or change it a bit depending on your objective, but to make sure you're not over concentrated in one of 2 asset classes. This is very, very critical here, folks. For example, if on the stock, bond, or REIT side, you are already overexposed in a particular property type, location, or deal structure, you may want to avoid investing into a crowdfunding platform that basically offers deals similar to what you already have. Because at the end of the day, it's all about asset allocation and diversification as well as risk mitigation. Let me give you a very simple example. Let's say you're buying a property on Fundrise. Not buying the property, you are investing in a property on Fundrise. And you realize that after doing the analysis on your stock, bond, and other security portfolio, you realize that you are already in that region where the property is located. Now, from a risk mitigation perspective, you might want to diversify, because God forbid something happens in that region, you'll be losing money not only at the stock, bond, and other security level. You'll also be losing money at the property level. This is what I mean in terms of diversifying. This is very important. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of another section of the Awesome Sweetie Kiwi Show. I'm having a convo with you today about how to invest in crowdfunded real estate online. And so step number one, you need to assess your investment risk. Step number two, you need to know your current portfolio's beta, very important. Step number three, you want to compare different crowdfunding platforms. And to choose the top real estate crowdfunding sites, you want to consider a variety of factors, including investment minimums, investor tap requirements. In other words, do they want accredited versus non-accredited investors? What are the platform fees? The total number of investors. This is important also. Total investor dividends. The frequency of those dividends also. Is it quarterly? Is it biannually? Is it yearly? You also want to think about the historical annual returns, the reinvestment opportunities, the website transparency. In other words, how easy it is to find platform fees, minimums, and redemption options. A lot of those platforms, they actually, they're pretty good. They come up with a comprehensive FAQ that basically answers all the questions that you may have. You also want to look at the Better Business Bureau ratings, so the BBB, and you also want to pay attention to their educational offerings. In other words, are they helping investors, especially newbies, understands the subtleties of real estate crowdfunding online. And you also need to understand, and this is for you right now, I'm speaking to you, when you are comparing different crowdfunding platforms, you need to understand accredited versus non-accredited investors. And what are the requirements for accredited investors? So the regulations for accredited investors vary from one jurisdiction to another, and they're often defined by a local market regulator or a competent authority. So we're talking about the United States. So in the United States, the definition of an accredited investor is put forth by the SEC, and they have a rule called Rule 501 of Regulation D. So the SEC defines an accredited investor as either an individual with gross income exceeding $200,000 in each of the two most recent years, or joint income with a spouse or partner exceeding $300,000 for those years, and a reasonable expectation of the same income level in the current year. And so that's one option, for one explanation, one path you can qualify for an accredited investor. Another path is if you are a person whose individual net worth or joint net worth with that person's spouse or partner exceeds $1 million, excluding the person's primary residence. And an entity is considered an accredited investor if it is a private business development company or an organization that has assets exceeding $5 million. Okay. And basically the purpose of all those requirements, the SEC, the government just want to protect investors. That's all. Because they're positing that if you have $200,000 in gross income and you have $1 million in disposable net worth, you are quote unquote sophisticated enough to understand the subtleties, the nuances of investment, including crowdfunding investments, real estate investment. So you are on your own. They're not going to protect you. But for the little people, for the everyday investor, this could be a problem. So this is why the SEC is putting those barriers there. And I also want you to know that the types of property you would like to crowdfund. This is important because as you are comparing different crowdfunding platforms and as you are understanding accredited versus non-accredited investors, you also need to think about the types of property you'd like to crowdfund. So if you are intent on developing, acquiring, owning, or flipping real estate that you or other investors are interested in, you have to think about things like residential, commercial, industrial, retail, mixed use, and raw land. This is the kinds of investment opportunities you would see on websites. Okay, excuse me. This is the kind of investment opportunities you would see on certain websites. So when you read the memo relating to that particular investment, you want to position yourself and know exactly what kind of properties we're talking about. Are we talking about residential properties, commercial, industrial, retail, mixed use, raw land? Because all those different types of properties have different risk profiles, right? They have different ROI spectra. They have different ROI profiles, if you will. So the risk reward equation will be different whether you are in residential, for example, versus raw land. Okay, so this is something you have to think about. And so at the end of the day, the real estate investment that is best for you will depend on a few factors. Besides your financial situation, your risk profile, your current employment status, your level of your level of investment sophistication, you also need to think about your vision, your retirement objectives, your estate planning objectives, and more importantly, your tax situation. The fiscal aspect of things is very important because real estate crowdfunding, as other types of investments, carries some fiscal implications. In other words, you have to pay taxes. You have to pay taxes on the dividends, and you may have to pay taxes on the appreciation of the underlying asset, the property. So you have to pay capital gains tax on the appreciation if you've held the property if you have held your investment for more than a year, and you're paying your regular income tax, your regular income tax rate. If you have received dividends or you have actually held the property, the investment, for less than a year. Step number 4, folks. So step number 1, you need to assess your investment risk. Number 2, you need to know your current portfolio's beta. Number 3, you need to compare different crowdfunding platforms. Number 4, you need to choose the right platform for you. Okay. And there are platforms for non-accredited investors and platforms for accredited investors. We have covered this topic extensively on other shows, so I'm not going to go into too much details here, but just know that when it comes to platforms for non-accredited investors, you have Fundrise and DiversyFund. Those are the top 2. So Fundrise is kind of cool. We love Fundrise because the fees are small, so the fees 1%. Other fees may apply. Account minimum $500. And so Fundrise is basically an online real estate company that lets average investors buy into private commercial and residential properties by pulling their assets through an investment platform. And the company offers e-REITs or real estate funds that don't trade on a public exchange. And then you have DiversyFund. Here, there are no fees. Account minimum $500 also. And this is pretty cool because with the $500 minimum investment and no management fees, DiversyFund gives a low-cost entry into the often high-roller world of real estate investing. And now let's talk about the platforms for accredited investors. So the first one is CrowdStreet. So CrowdStreet is kind of cool. The fees 0.5% to 2.5% for funds, and project fees vary. And account minimum here $25,000. And then you have EquityMultiple. Account minimum is $5,000. The fees 0.5% to 1.5%. Okay. And we also have YieldStreet. So account minimum here is $5,000. The fees you're looking at the 1% to 2.5% management fees, besides other fees. You also have PeerStreet. So PeerStreet, the minimum investment is $1,000, and the fees oscillate between 0.25% to 2%. And this is pretty cool. Now, one thing we have seen in our research is that the ROIs, the average ROIs for all those platforms fluctuate between 8 to 15% annually. So this is pretty cool. All right. And one thing you also need to remember is that those platforms will actually, the platform for accredited investors, they will double check your status, your accreditation status. So don't lie on the platform. It's they will check it, and it's not legal. So if you want to go for an accredited investor platform, make sure you are indeed an accredited investor. Okay. Step number 5, folks. We're still having a conversation today about how to invest in crowdfunding real estate online. Step number 5, this is another important step. Auto invest. Let me repeat that. Auto invest. I want you to invest automatically. What is auto invest? Auto invest allows you to schedule automatically recurring monthly or twice monthly contributions to help you build your crowdfunding real estate portfolio effortlessly over time. And auto investments are diversified across funds that match your plan, offering you exposure to new funds over time. So we've seen a couple of auto invest features actually online. So for example, you have Fundrise. So with Fundrise Auto Invest, you can enable auto invest at any time from the auto invest section of your Fundrise account settings for minimum contributions of $100. And any contributions should be withdrawn from your primary bank account on file. What about PeerStreet? PeerStreet also has an auto invest feature. So automated investing enables you to build a personalized, diversified investment portfolio that meets your specific investment criteria. And automated investing will hold your spot in investments that meet the criteria you set as soon as they become available. And your spot will be reserved for 24 hours so you can review the investments. And if you don't cancel that reservation within 24 hours, PeerStreet will invest for you up to your specified investment amount. You will receive an email confirmation for every automated order. YieldStreet, there is no auto invest feature at the moment. EquityMultiple, the same thing, no auto invest feature at the moment. CrowdStreet, no auto invest feature at the moment. DiversyFund has a great auto investor process. You can be an auto investor, so you have monthly auto deposits to your investment account. You can build wealth on autopilot. You can reach your investment goals quicker, and you can receive a diversified portfolio of commercial real estate assets. That's for auto investor. You can also choose the high growth investor option. There, you can invest additional funds or enable auto invest at any time. You can build long-term wealth. You can accelerate your wealth creation with a higher dollar amount working for you, and you can receive a diversified portfolio of commercial real estate assets. The cool thing here is that when it comes to DiversyFund and the way they have put it in a wonderful way. So auto invest will benefit you through several ways. So you're paying yourself first. You're paying with small investment amounts. You can take advantage of the dollar cost averaging, right? You can save on commission and fees, and you don't have to wait no more for lump sums. So this is pretty cool. One thing you also have to think about in terms of auto invest is the reduced tax burdens. So when we talk about fiscal burden, we are referring to 3 types of benefits, especially when you consider crowdfunding real estate online. So you have dividends, that's number 1. You have asset appreciation, and you have the possibility of tax loss harvesting. Okay? Because at the end of the day, think about it. The dividends and the asset appreciation, if you time your investments, if you time your withdrawals, if you time your liquidations properly, you can really reduce your tax debt. At the end of the day, one thing I want to say here is that real estate crowdfunding is a form of real estate syndication, really, because this form of investment has become more common in recent days, but investors often get confused on the tax treatment. So that this treatment is certainly not the same as you would see in other types of investment like stocks and bonds. So the first thing to understand is that an equity investor in a syndication is actually a partner in a partnership. So investments in syndications will generally be considered passive activities from an IRS standpoint. And for a real estate entity, there are typically two sources of passive activities. So you have rental activities, so rentals of apartments, commercial buildings, retail centers, unless the taxpayer is classified as a real estate professional. So that's one. Or you can have a business. So you have flips, real estate development, in which the taxpayer does not materially participate. So passive activities will generate either passive income or passive loss. So interest, dividends, annuities, and gains on stocks and bonds are not considered passive activities. So as a real estate investor on a site such as Fundrise or EquityMultiple and so on and so forth, you are considered a passive investor, and any income or loss actually that flows through your account is considered passive income. And the K1 that you, the investor, the schedule K1 that you, the investor, receives at the end of the year from the syndication will either report income or loss, as well as other items. And at that time, you will then include this on your tax return, typically following the rules for passive activities. If the schedule K1 reports a loss, then you, the investor, has a passive loss. Passive losses can only be offset against passive income. Of course, subject to certain exceptions. We've covered this on other shows, so I'm not getting into any detail here. All right. Just know in general that capital gains taxes are 15%, and short-term gains taxes are set at your normal tax rate. Okay, this could be 25%, 30%, or 33%. All right, folks. Thank you so much for your attention today. I really appreciated it. I was giving you a step-by-step on how to invest in crowdfunding real estate online. First, you need to evaluate your investment risk. Number 2, you need to know your current portfolio's beta. Number 3, you need to compare different crowdfunding platforms. Number 4, you want to choose the right platform for you. And number 5, you want to consider auto investing. Very important. Thank you so much for your attention, folks. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.